This is an analysis from Alpha Business Media. Welcome back to the Deep Dive. It is great to have you with us. Today, we are transporting ourselves to the Himalayas. But, and I have to warn you right off the bat, we are not here for the trekking.
No. No Everest this time, no Annapurna Circuit.
Exactly. We are here to talk about a massive, largely invisible shift that's happening right now in the economy of Nepal. We're talking about the booming IT and business process outsourcing sectors.
It really is a fascinating shift. You have this image of Nepal that's rooted in tourism and agriculture, but under the surface, there's this bubbling volcano of digital export activity.
Digital export.
Yeah.
So things like code, design, data analytics.
All of it. It's all being piped out of Kathmandu to places like Silicon Valley, London, and Singapore.
It sounds like an incredible success story. I mean, a developing nation leapfrogging into the digital age.
It should be.
But, as we know, there is always a but on this show. And today's but is a big one. We are unpacking a critical legal paradox, a sort of glitch in the matrix that is threatening to strangle this entire industry in its crib.
It is. It's a classic, really painful case of a 21st century industry trying to sprint while, it's shackled to a 20th century tax code.
Specifically, we are looking at a situation where this industry, which the government says it wants to support, it's technically supposed to be tax exempt to stay competitive.
Right.
And yet it's facing this legal loophole, a loophole that allows the taxman, the Inland Revenue Department, to just slap a flat 13% VAT on their earnings.
And we really need to be clear about what that 13% means.
Yeah.
In the service game, especially IT outsourcing, your margins can be pretty thin. You're competing with Vietnam, with the Philippines, with India.
Of course.
A sudden 13% tax on top of your revenue. I mean, that isn't just a nuisance. For a lot of these companies, that is the difference between being a competitive global player and just closing up shop entirely.
So the stakes are that high. It's life or death for these startups.
Absolutely.
So today's mission is to unpack this paradox. We're going to look at the place of supply trap, which is the legal mechanism causing all this headaches.
And we're going to walk through the specific, actionable defense strategies that businesses are actually using to protect themselves.
And we'll also look next door to India to see how they solve this exact same problem.
Yeah, the sources we have today are excellent for that. They don't just complain about the law, they really break down the mechanics of the failure, and crucially, they offer a survival guide.
Okay, so let's set the scene properly. When I think of the Nepali economy, and I think most people are the same, I think tourism or remittances.
Yeah, workers going to the Gulf or Malaysia and sending money home. Historically, that has been the model.
Right.
But the sources highlight this digital retention model emerging in cities like Kathmandu, Lalitpur, and Chitwan. You have this whole generation of young, tech-savvy professionals who realized they don't have to leave the country to earn foreign currency.
They can just sit at a desk in Lalitpur and work for a client in New York.
Exactly. They are exporting their brain power.
So software development, graphic design.
Customer support, AI training data, you name it. And this brings in foreign currency, which is absolute gold for the Nepali economy. The government knows this. They want to encourage it.
So they create a policy for it.
Prowess. Policy-wise, they've classified these service exports as zero-rated for value-added tax, or VAT.
Okay, let's pause and unpack zero-rated.
Oh.
To the uninitiated, that sounds like boring tax jargon. But in this context, it's basically the holy grail, isn't it?
It is the golden ticket. Zero-rated is actually better than being tax-exempt. If you're tax-exempt, you just don't charge tax. Simple.
Okay.
But if you're zero-rated, it means the tax rate on your sale is 0%, and this is the kicker, you can claim refunds on the VAT you paid on your own business expenses.
Oh, wow. So if I buy a bunch of MacBooks for my developers or pay for expensive server space, I pay VAT on those things.
Mm-hmm.
But because my product, my export, is zero-rated, the government gives that money back to me.
Precisely. The logic is, we want your exports to be as cheap as possible for the global market. We don't want to burden you with local taxes. It makes Nepali exports competitively priced.
So on paper, the system is designed perfectly. The government wants exports, they give them zero-rated status, the industry grows, everyone wins.
That's how it should work.
So where does this 13% trap come from? How does it all go so wrong?
It goes wrong because of a specific piece of legislation. It's called the Value Added Tax Act, 2052.
2052. That sounds like we're reading a sci-fi novel.
It does, doesn't it? But that's the Nepali calendar year. In the Gregorian calendar, which most of us use, that year is 1996.
1996, okay. Let's
And
put that in context. I was barely using email in 1996.
exactly. I mean, think about the technological landscape of 1996. Amazon was just a bookstore. Google wasn't even founded yet. The iPhone was more than a decade away.
The idea of a digital economy or a remote work.
It basically didn't exist. So this law was written for a physical world.
Right. For tangible goods.
Precisely. It was designed for things you can drop on your foot. If you weave a carpet or a pashmina shawl in Kathmandu and you ship it to Paris, the tax situation is obvious. The carpet physically crosses a border, it gets a customs stamp, everyone agrees that is an export.
But you can't put a custom stamp on a line of Python code.
You cannot. And that is where the friction starts. The VAT Act has a section, specifically Section 14.2a, that defines something called the place of supply.
Place of supply. That sounds like the critical mechanism here.
It is the heartbeat of the problem. For tax purposes, you have to determine where a service happened. The Act says that for services, the default place of supply is determined by where the service is performed.
Performed. Okay, I can already see the trapdoor opening. If I'm a developer and I'm sitting in my office in Nepal writing code,
Then you are physically performing the work in Nepal.
even if the code is for a startup in San Francisco.
Yeah.
Even if I never even used the code myself.
The law, written in 1996, it just looks at the act of labor. It sees you typing in Kathmandu. The Inland Revenue Department, the IRD, interprets that strictly. They say, look, the performance is happening on Nepali soil. Therefore, the place of supply is Nepal.
And if the place of supply is Nepal,
Then it's a domestic transaction. It's treated exactly the same as if you sold that code to the bakery next door.
and the client, the tech company in California, is obviously not registered for VAT in Nepal,
So the IRD treats it as a supply to an unregistered consumer.
which triggers the tax.
Boom, 13% VAT default rate.
That is wild. So effectively, the fact that you are physically breathing air in Nepal while you work nullifies the fact that you are exporting the value to another continent.
That is the analog law in a digital world paradox. The law just assumes that services require physical presence and local consumption. It has no concept of the fact that digital work can be performed in one place, but consumed and enjoyed entirely in another.
It feels like a bait and switch. The policy says, export, we love you.
Yeah.
But the tax code says, gotcha, you're local.
And the sources point out something really important here. It's not that the IRD always charges this tax. It's that the ambiguity allows them to. It turns the 13% tax into a default risk. It just hangs over every company like a sword of Damocles.
And that uncertainty is just poison for business. You can't plan. But let's pivot to the solution. Our sources are actually quite strategic. They argue businesses aren't helpless. They say the vulnerability isn't just the law, it's the paperwork.
This is where we get into the corporate line of defense. The source material is very clear. Your product is not just your code or your design. Your product is your contract.
I love that. Your product is your contract. Because I imagine a lot of these startups are run by tech people, not lawyers. They're probably using informal agreements.
All the time. Quick email chain. Can you build this app? Sure, $5,000. Great, start Monday. Or they just download a generic template from the internet.
And that is dangerous.
Oh, it is lethal. For the tax authorities, that kind of informality is a gift. If your contract is silent or vague on the place of supply, the IRD will fill in the blanks with their own interpretation.
Which is performance in Nepal.
Exactly.
So let's go through the fix. The sources outline 4 specific pillars, 4 non-negotiable elements that need to be in a service contract to fight this 13% tax. What is Pillar 1?
Pillar 1 is the explicit definition of place of supply. You cannot leave this open to interpretation. You need a clause in your contract that explicitly states the place of effective use and enjoyment is the client's location.
So you are basically writing your tax argument directly into the contract itself.
Exactly. You're creating a legal reality within the document. You use language like, the transaction constitutes an export of services as per the laws of Nepal. You state clearly that the benefit of the service is consumed abroad.
You're countering the performance argument with a consumption argument. We made it here, but it's eaten there.
That's a perfect way to put it.
Okay, that makes sense. Define the geography of value. What is Pillar 2?
Pillar 2 is evidence of foreign status. The IRD is skeptical by nature. They might argue, how do we know this client X isn't just your cousin's company in Thamel pretending to be foreign?
Right. How do we know this isn't a shell company? So you have to prove the client is real and foreign.
You need to know your client, or KYC. The contract must obligate the client to provide proof of their incorporation. A tax residency certificate from their home country, a certificate of incorporation.
And you just attach this to the contract.
You append it. It becomes part of the evidence file. It stops the IRD from claiming you're dealing with a local unregistered party. You say, no, look, here's their U.S. tax ID. They are a bona fide foreign entity.
Smart. It closes that loophole.
Okay.
The pillar 3. This one sounded the most technical to me. Electronic delivery mechanism.
This is my favorite one because it's so modern. The contract needs to describe how the work moves from point A to point B. You want to disconnect the service from your physical desk in Lalitpur.
So instead of just saying, I will write the code, you say,
You say something like, deliverables shall be transmitted electronically to the client's secure server located in the United States.
I see. You are defining the handover point?
Exactly. You're arguing that the supply happens on their server, on their soil. You are digitally transporting the service across the border.
That is really clever. It uses the technology itself to define the legal boundary. Okay, and finally, pillar 4. This seems like the boring one, but I bet it's where everyone trips up. Invoicing alignment.
It is the classic stumbling block. You can have the most beautiful, bulletproof contract in the world, but if your accountant sends an invoice that doesn't match it, you lose.
The story has to stay consistent across every single piece of paper.
Precisely. The invoice needs to explicitly label the line items as export of services 0 rated VAT. It has to reference the contract. And, this is the most critical part, it must be backed up by bank records showing convertible foreign currency.
The money trail.
The money trail is the ultimate truth. If you get paid in Nepali rupees, you are dead in the water. You cannot argue it's an export. You need those SWIFT transfer copies showing dollars, euros, or pounds hitting your account.
So foreign currency is the objective proof that makes the rest of the argument hold water.
It's the foundation. Without the foreign currency, the contract doesn't matter. With it, plus the contract, plus the server logs, you've built a fortress.
It effectively shifts the burden of proof back to the taxman. You're saying, here's the chain of evidence, try to break it.
Correct. It transforms you from a vulnerable startup into a compliant exporter.
Now, I want to zoom out a little bit.
Yeah.
Because whenever we talk about Nepal's economy, we have to talk about the giant next door, India.
Elephant in the room.
India exports, something like $250 billion in IT services a year? They're the global leader. Did they face this problem, this place of supply headache?
Oh, they absolutely did. India has a famously complex tax system, but they realized early on that if they wanted to dominate the global IT market, they couldn't shoot themselves in the foot with export taxes.
So how did they solve it? Did they change the definition of performance?
They went a step further. When India implemented their GST, the Goods and Services Tax, they introduced the IGST Act, and in Section 2(6) of that act, they gave a masterclass in legislative clarity.
What did they do differently?
They changed the definition of export of service instead of looking at where the work is performed.
Right.
India explicitly defines the place of supply based on the location of the recipient.
That is a fundamental shift in logic. It just flips the camera angle.
Completely. The Indian law basically says if the supplier is in India, the recipient is outside India, and the payment is received in convertible foreign exchange, then it's an export. End of story.
That is so clean. It makes the location of the programmer irrelevant. I could be coding on a beach in Goa or in a high-rise in Bangalore. It doesn't matter where my fingers are.
It matters where the client is. It just removes all the ambiguity. If the money comes from abroad and the client is abroad, it's an export.
Why hasn't Nepal just copied that? It seems like such an obvious solution. CRE LLC, CRED LLV, the Indian law.
Well, Nepal has the data part. The central bank knows when dollars come in. But the VAT Act, remember, 1996, it lacks that legislative link. It doesn't explicitly say foreign currency receipt equals export.
It just falls back on that old performance default.
Because the law hasn't been updated to override it. We have a situation where the banking system is operating in 2025, recognizing the foreign money, but the tax law is stuck in 1996, looking for a physical factory floor.
That brings us to the strategic outlook, because this feels like a ticking time bomb. You have a growing industry and a restrictive law. Something has to give.
The sources outline two main paths. The first is what they call the base case, or just stagnation.
Stagnation? That sounds depressing. What does that look like?
It looks like the status quo. The legislative ambiguity remains. The government doesn't update the law.
And who wins in that world?
The lawyers win, and the big companies win. If you're a massive IT firm, you can afford the best legal teams to draft those bulletproof contracts. You can survive an audit.
But the little guys, the freelancers, the two people in a garage trying to build the next big app.
They get crushed. They're the ones who can't afford the risk. So they either pay the 13%, which makes them uncompetitive, or more likely, they just go underground.
They stay off the grid.
Right, they use personal bank accounts, they don't scale, and because they don't scale, they can't get big contracts, they can't get loans, and the industry just stays fragmented.
It creates a glass ceiling on the whole economy. Okay, let's look at the brighter side. Scenario 2.
Scenario 2 is the legislative leap. This is the optimistic case. And the frustrating part is that this is actually pretty easy to do. It doesn't even need a full act of parliament.
Really, they don't have to rewrite the whole VAT Act.
Not necessarily. The Inland Revenue Department or the Ministry of Finance could issue a binding directive or a circular.
Just a memo.
Basically a memo with legal weight. A circular that says, clarification. For digital services, the place of supply shall be considered the recipient's location, provided payment is in foreign currency.
That's it. One sentence could fix this.
One sentence could unlock millions in investment. It would formalize the sector overnight. If you know you're safe from the 13% tax, you're going to register your business. You're going to bring your earnings through the formal channels. You'll pay income tax.
So, ironically, by giving up the 13% VAT, the government would probably make more money in the long run.
That is the standard economic argument. You lose the VAT, but you gain a booming formal industry that pays income tax and employs thousands of people.
It seems so logical. Which leads us to the hard truth. Why hasn't this happened? Is it just incompetence or something else?
The sources suggest it might be the strategic asset theory. And this is a bit cynical, but it's a reality. Ambiguity is power.
Ambiguity is power. Unpack that.
If the law is gray, the tax officer has discretion. If the government is short on cash this quarter or they need to plug a budget hole, they can audit a few IT firms and interpret the law in their favor to fill the coffers.
So it's a rainy day fund. We can squeeze this industry if we need to.
Exactly. If the law is crystal clear, the state loses that leverage. The sources argue the ambiguity might be maintained intentionally to keep those options open.
That is a terrifying thought for a business owner.
Which is why the final recommendation from the sources is about unity. Individual companies cannot fight this strategic ambiguity alone.
They need to band together.
The industry associations, the chambers of commerce, they need to present hard data. They'll need to show the government the math. Look, here's the trajectory of the IT sector. If you fix this, we will contribute X amount to the GDP. If you don't, we flatline.
They need to prove that killing the golden goose is not a valid tax strategy. This has been such a fascinating look at how legal infrastructure is just as important as physical infrastructure. You can have fastest internet in the world, but if your tax code is broken, the industry just won't work.
Absolutely. You cannot run a digital economy on analog laws.
So let's wrap this up. What are the key takeaways? If I'm running a tech company in Nepal, what do I do tomorrow morning?
I would say 2 immediate actions. First, audit your contracts right now. Do not assume you're safe just because you're exporting in plain English.
Check for the 4 pillars.
Check for the pillars. If you don't have a defined place of supply, proof of foreign status, the electronic delivery clause, and if your invoices don't match, you are walking through a minefield without a map. Fix the paperwork.
You have to be a risk manager first and a coder second.
Until the law changes, yes.
Wow.
And the second takeaway is for the broader ecosystem. Push for the legislative leap. Support the lobbying efforts. Because ultimately, contracts are just a shield. The industry needs the threat removed entirely.
And for any policymakers who might be listening,
the message is simple. Ambiguity is expensive. It costs the country growth, it costs foreign currency reserves, and it drives your best talent to other countries where the rules are clear.
a powerful place to leave it.
And I want to leave you with one final thought. We talk a lot about digital transformation in developing economies, but usually when people say that, they're talking about technology, fiber optics, 5G, data centers.
The hardware.
The hardware. But this case proves that true transformation isn't about the tech, it's about the bureaucracy. If a country like Nepal wants to transition from an economy based on remittances, sending its people away to work, to an economy based on digital exports, keeping its people home, can it really afford to keep a tax code that was written before the smartphone was invented? Or is the comfort of that ambiguity simply too high a price to pay for the future?
A massive question for the future of the Himalayan economy. Thank you so much for guiding us through that deep dive.
My pleasure.
And thank you for listening. We will catch you on the next deep dive.